Everyone talks about inflation like it's just price hikes, but real analysts ask, what's anchoring expectations, and what's breaking transmission? At the hyper-advanced level, inflation is about monetary velocity, policy lag, and expectations management. You can raise rates, but if liquidity's still sticky, real demand doesn't move. You can cut supply shocks, but if labor markets remain tight, core services inflation stays elevated. Then there's second-round effects, like landlords pricing future rent hikes into current leases, or firms using inflation as cover for margin expansion. That's not supply or demand, that's pricing power at play. And behind it all, forward guidance and credibility. If people don't believe inflation will fall, it won't. That's the expectations loop the Fed fights hardest to control. Here's what most people miss. Inflation targeting isn't just about 2%. It's about anchoring belief that it will stay near 2% long-term. Central banks don't just move interest rates, they shape narratives. A dovish tone with a hawkish move or vice versa sends a stronger signal than a rate hike alone. Also, watch for real rates, not nominal ones. If inflation expectations fall while nominal rates stay flat, policy tightens without a single hike. And then there's global divergence. When the Fed tightens but the ECB or BOJ doesn't, capital flows shift, currencies move, and imported inflation changes the game. Bottom line, inflation isn't just economic, it's psychological, political, and structural. Follow the money ripple. We don't just report the numbers, we read between them.